Happy New Year, everyone, and thank you for joining us as we present our 10 themes for 2025. After another strong year, the question on everyone's mind is, can the momentum we've seen in the economy and financial markets continue into this new year? Let's dive into our outlook and explore what the future holds. We'll try to answer that question through our 10 investment themes for the year: optimism overload, U.S. economy, monetary policy, fixed income, U.S. equities, sectors, mid-cap equities, international, risk management, and asset allocation. Let's get to the first theme, optimism overload. There's been a rise in confidence since the 2024 election, and it's been broad-based. Small business confidence saw its largest monthly increase since 1980. Large company CEO confidence rose to the highest level in 2.5 years. Consumer confidence about the future hit the highest level in 3 years, and investor confidence, those thinking the equity market will rise in the next 12 months, soared to an all-time high. Investors are hoping to see positive headlines like those on the left over the next few months. Headlines like there's a resolution found between Russia, Ukraine, or in the Middle East, DOGE, the Department of Government Efficiency, is able to cut the deficit, or there's regulatory rollbacks, or U.S. growth continues to surpass expectations. While the good news is we may well see some of these things happen, the bad news is a lot of that is likely already priced into the markets. Now, the potential negative headlines, like any of the ones you see here on the right, could cause increased volatility and disappoint the markets as we move through this year. Here are some of our favorite quotes from some of the most successful investors in history. Benjamin Graham, often considered the father of value investing, once said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Sir John Templeton, a Graham disciple, said bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And of course, from one of the most successful investors of our time, Warren Buffett, "Be fearful when others are greedy, and greedy only when others are fearful." Now, these quotes aren't meant to frighten everyone, but they do offer important lessons, especially as we head into this year. Over-optimism can be a concern, and it's a good reminder for us to temper our expectations, particularly after the 2 strong years that we've had. Turning to the economy. As we look ahead to this year, let's review a few possible economic scenarios. On the left, we have factors that would be negative for the economy, and on the right, factors that would be positive. The good news is that we've already rolled out some of the biggest risks. For example, we don't anticipate negative job growth, a recession unfolding, inflation surging back to 5%, or a significant downturn in consumer spending. Of course, there are still some risks on the horizon, like the potential for a black swan event, which by nature is unpredictable. But overall, the more positive scenarios remain very much in play. These include inflation continuing to fall thanks to lower energy prices, ongoing consumer resilience, and strong spending in sectors like AI. So while there are some uncertainties, the outlook for the economy is balanced, with several encouraging factors. After growing at 2.7% in 2024, we expect the U.S. economy to grow around 2.4% this year. Key drivers of this growth include healthy consumer spending. We anticipate continued strength in consumer spending, particularly in services like dining out and healthcare, reindustrialization, and fiscal policy. Ongoing fiscal spending will support the economy, with 75% of recent stimulus funds still yet to be spent. Business spending on AI will remain a key driver. This not only boosts the economy through direct spending and technology, but also improves productivity, further supporting growth. A focus on deregulation should provide a favorable environment for the markets, helping drive economic momentum. And we believe the Federal Reserve will continue its path of easing, helping to maintain the economic expansion. All these factors should contribute to a steady economic growth outlook for the year. Turning to the Fed and monetary policy. The Federal Reserve's dual mandate consists of 2 key goals: containing inflation and maintaining full employment. While this relationship isn't new, the post-pandemic environment presents unique challenges, such as the surge in inflation. For the Fed to cut interest rates and sustain the current economic expansion, these two objectives will need to work in harmony. We expect inflation to continue its gradual decline, driven by factors like falling energy prices, discounts from retailers, a strong dollar, and hopefully a retreat in shelter costs. One potential risk to inflation is the impact of tariffs, though we believe these risks are overstated. Job creation should remain strong over the next 12 months, averaging around 145,000 jobs per month. While that's a slight decline from 190,000 in 2024, it's still a solid pace. As a result, we expect the unemployment rate to stay steady throughout the year. Looking ahead, we anticipate the Fed will implement 2 interest rate cuts in 2025, bringing the Fed funds rate down to around 4%. While we expect a pause at this next meeting here in January, we believe the easing cycle will resume as the year progresses. The key takeaway here is that the focus should be less on the number of rate cuts and more on the outcome, a continued economic expansion. The Federal Reserve closely monitors the relationship between inflation and job growth because this dynamic often determines whether we experience a recession or continue with economic expansion. If you take a look at this chart, you'll see the correlation between job growth along the x-axis and inflation along the y-axis. The color of the circles represents economic conditions, the red for recessions and blue for periods of positive growth. The size of the bubbles shows the scale of that growth. When we focus on the red bubbles, we see that 70% of those cases, inflation was above 2%, often much higher, indicating that the Fed was likely raising rates to slow down the economy. Moreover, 87% of the time, recessionary conditions occurred when monthly job growth was below 100,000. This combination of weak job growth and the Fed tightening rates to combat inflation is a strong indicator of the conditions that can lead to a recession. On the flip side, when inflation is around the 2% level and job growth remains healthy, we typically see strong economic expansions. Take the 1990s, for example. This period marked the second longest expansion in U.S. history, lasting a full 10 years. It was the last time we experienced a soft landing. And similarly, from 2009 to 2019, the U.S. saw the longest economic expansion on record, which only came to an end due to the COVID-19 pandemic in 2020. In both cases, the combination of controlled inflation and steady, modest job growth was key to sustaining these long expansions. This same dynamic is what we believe can help to extend the current economic expansion. Here's the good news. If you look at the last 10 quarters, we're trending in the right direction, hitting that sweet spot where the expansion can continue. If this trend holds, risk assets like the equity market should see positive benefits. And now for the fixed income market. Our base case for the 10-year Treasury yield in 2025 is 4.5%. This outlook is based on our forecast of 2.4% economic growth and inflation continuing to trend lower. We also expect demand for treasuries to remain healthy at current levels, driven by both retail investors and by foreign demand. This is why we don't foresee yields rising to the 6 or 7% range. In this environment, high-quality corporate bonds and municipal bonds look like attractive investment opportunities. Now, let's take a look at the equity markets. As we touched on earlier regarding over-optimism, the S&P 500 has had an impressive run over the past 2 years. Earnings grew by 10% during this time, but what truly fueled the returns was a roughly 40% increase in the multiple that investors were willing to pay for those earnings. In fact, this PE expansion has accounted for about 3/4 of the S&P 500's performance over the last 2 years. But there are limits to how high the PE multiple can go. We believe we are now at the top end of that valuation range, which is why we're adopting a more cautious outlook. So far, the increase in the PE multiple has been justified by factors such as Fed rate cuts, moderating inflation, higher interest rates, higher quality earnings, and improving sentiment. As we approach the peak of this multiple mountain, for the markets to go higher, we're going to have to see earnings grow. The good news is, we believe earnings will continue to grow, projecting a 13% increase with an appropriate PE multiple of 23.5 times. The math works out to a target of 6,375 for the S&P 500. This suggests a solid potential for continued growth, driven by earnings performance. Our target aligns with a typical third year of a bull market, where the average return has been around 2 to 3%. From a presidential cycle perspective, the first and fifth years tend to see more modest gains, typically in the range of 6 to 8%. A more bullish scenario could unfold if earnings are higher than expected, the economy proves stronger than anticipated, margins continue to expand, and Washington's deregulation and tax policies become even more favorable. However, we assign a 30% probability to this bullish case and a 20% probability to a bearish outcome. This means the risks are fairly balanced for the year ahead.
Let's now take a closer look at the key sectors within the equity space that we favor. Our approach to analyzing these sectors is simple. We follow the long-term macro trends, and second, we focus on the sectors with the best earnings potential. And with that approach, this analysis highlights three key sectors: technology, industrials, and healthcare. When you look at technology, it has outperformed in 11 out of the last 12 years, mainly because it keeps innovating. With the new advancements in AI, we believe we're still in the early stages of this AI trend. In fact, it just continues to gain momentum. One thing we track is how often AI is mentioned on earnings calls across S&P 500 companies. Last month, mentions hit a record high, and since the start of 2023, they've gone up 450%. Industrials are the reliable all-rounders. They're benefiting from ongoing government spending, the reindustrialization of the US, the AI build-out, and the push to update our power systems. Healthcare is an undervalued sector with potential. If you look at the performance of healthcare last year, it was the second worst performing sector in the S&P 500. But that's not unusual because healthcare tends to underperform during election years. But the year after the election, healthcare tends to bounce back. Plus, with aging populations worldwide, demand for healthcare will keep growing, not just in the US, but globally. From a fundamental perspective, we want to look for sectors with the best earnings growth. You can see highlighted in this chart that the sectors with the top 3 earnings growth estimates are our 3 favorite: technology, healthcare, and industrials. Our favorite sectors have earnings comfortably in the double-digit territory and also represent 3 of the fastest growing sectors in the market today. With elevated valuations, you want to be in sectors that have the best earnings growth. Looking at market capitalization size, we like mid-cap stocks this year. We believe that mid-cap stocks are well positioned to outperform moving forward as they offer balance between a few of the market risks that we see ahead. We believe mid-cap stocks could be the sweet spot in the equity market in 2025, balancing growth potential at an attractive valuation. When you look at the performance of large, mid, and small cap stocks over the last 5 years in this chart, there's no doubt large cap has been a significant outperformer. But going forward, we think mid caps have a chance to outperform large cap stocks. Let's focus on the middle column, which is evaluations. And if you look at the PE multiple of mid caps, it is significantly lower than large caps and modestly lower than small caps. So from an evaluation perspective, mid cap stocks are attractive. When comparing mid cap and large cap stocks, both have the same earnings growth at 13%. However, mid cap stocks make more of their money here in the US, while large cap companies rely more on international revenue. This matters because if tariff wars break out, large cap companies could be hit harder with those tariffs, while mid caps may be less affected. When it comes to mid cap versus small cap, one of the reasons why we were inclined to invest in small caps last year is that we thought the Fed was going to be very aggressive in cutting interest rates. And that was very important because 53% of their financing is done with short-term floating rate debt. However, going forward, we don't think the Fed is going to be as aggressive cutting interest rates. So that's why we've moved up the market capitalization scale and we've shifted our focus to mid-cap stocks instead. In addition, when you look at our favorite sectors, you get slightly more exposure to mid-caps than you would in small caps. When it comes to international equity markets, the US equity market remains the strongest. The reason for US dominance is threefold. First of all, when you look at economic growth for the upcoming year, the US is expected to have the best growth versus all of the other developed countries. In fact, what's really important here is that when you look at the revisions over the last 3 months, the US has an upward revisions in their growth forecast for the upcoming year. When you look at Italy, France, and Germany, we're actually seeing downward revisions. So the momentum and the magnitude of growth continue to be in the favor of the US economy. the US economy still has strong growth, which leads to better earnings. For example, our forecast is 13% earnings growth, while the consensus is around 15%. That's about double what Japan and Europe are expected to see in 2025. The third reason is that US companies are the most dominant companies in the world. And one of the reasons why that tends to happen is because the United States excels in fostering and nurturing innovation, and that's a trend that has been evident over decades. Despite having only 4% of the world's population, the US is home to 63% of the top 100 global companies. This dominance is largely due to the robust infrastructure that supports company development. The US leads in venture capital funding, attracting approximately 50% of global venture capital investments. To put this in perspective, the next largest recipient, China, only attracts 16%. The bubbles on the slide represent the number of publicly traded companies created in the last 50 years with the current market cap exceeding $50 billion. The US boasts a diverse group of over 90 such companies with a combined market cap of around $28 trillion. This includes well-known names like Apple, Microsoft, and NVIDIA. Europe has produced only 13 such companies with a total market cap of approximately $1.8 trillion. So with this comparison, we can visually see that the US has been very successful in generating these new businesses across different sectors to become dominant in their spaces. That's one of the reasons why, when we take a look at global equity market caps, 50% of the world's total market cap now resides here in the United States. For our ninth topic, we think selectivity and risk management will be critical this upcoming year. In an environment where valuations are stretched virtually across all asset classes, we believe that fundamentals will be key in 2025. Within fixed income, with spreads at over a decade low, investors should focus more on some of the higher quality areas, such as investment-grade bonds and municipals, and avoid taking outsized risk within the high-yield space. Within the equity space, we like the large and mid-cap stocks. And when it comes to emerging markets, we do have a weaker global environment when it comes to economic growth. And we think if there are tariff wars, there are some significant emerging market countries that could potentially be penalized. And then this is a surprise, but if you look at commodities performance over the last 20 years, on average, it has been slightly negative. And for our forecast, we see there's probably more downside pressure to commodities, particularly in the energy space. We anticipate increased dispersion among winners and losers within regions, sectors, and industries. Although 2024 was a strong year for risk assets, we do see significant dispersion beneath the surface. Globally, the US was the best performing equity region, outperforming the worst, Latin America, by 50%. Regionally, within Europe, best performing Italy outpaced worst performing Portugal by 38%. All 11 U.S. equity sectors were in the positive territory. The strongest sector, which is communications, outpaced the worst, materials, by 40%. From an industry perspective, the best performing industry within communication services, entertainment, outperformed the worst by about 54%. With this data, we can see that the dispersion was elevated even in a robust year for the market. In a shifting landscape, 2025 will likely be a year where active management proves its worth. And with the final theme, we do believe that asset allocation and diversification are going to be an important theme this year. The key takeaway is that understanding your risk profile and having a clear strategy are essential for effectively solving your asset allocation puzzle. So for our last theme, let's take a guess at the following question. Why is asset allocation so important? Is it A, strategic decision making, which means you need to have a plan in place so that you have the maximum opportunity to achieve your goals? Or is it B, diversification, with the concept that you don't want to put all of your eggs in one basket and you want to mitigate your overall portfolio risk? Or C, risk management, to make sure that your risk tolerance is consistent with your objectives? Or is it D, unpredictability, meaning that you should have a plan in place when volatility does hit so that you don't have those knee-jerk reactions and sell at the wrong time? The correct answer is all four of these are critical to asset allocation and achieving your goals. By thoughtfully combining different investments, bonds for stability, equities for growth, and speculative assets for high-risk opportunities, you can create a balanced and resilient portfolio. A well-thought-out financial plan and strategic approach significantly enhances your chances of achieving your investment goals. And that concludes our 10 themes for 2025 presentation. Thank you for your time and attention today. We truly appreciate the opportunity to partner with you, and we are wishing everyone a happy and healthy year ahead. Thank you.